Welcome to The Explainer. If you've ever glanced at the Indian stock market and thought, wow, that just looks like a massive high stakes guessing game, you are definitely not alone. But what if I told you it's not about guessing at all? Today, we're going to flip that whole idea on its head, and we'll start with the biggest question on everyone's mind. Let's be honest, this is what it feels like, right? You see those numbers flashing green and red, going up and down. It's easy to see it as this giant casino, a game of pure chance where fortunes are just won or lost in the blink of an eye. But here's the thing, and this is the secret. For people who know what they're doing, the market isn't a casino at all. It's actually a system for buying a small piece of a real, living, breathing business. And that simple idea is the key mindset shift we're making today, thinking less like a gambler and more like a business owner.
Okay, so where do these stocks actually come from? Where do they live? Well, to really get it, you first need to understand that the market has two totally distinct realms.
Think of it like this. The primary market is like the factory where new shares are created. This is where a company has its initial public offering or IPO. When you buy shares here, your money goes directly to the company, so it can build new factories, hire people, and grow. Now, the secondary market, that's what we see every day on the news, places like the NSE or BSE, that's more like a giant marketplace. Here, we're all just trading existing shares with each other. The money just moves from my pocket to your pocket, and the company doesn't see a paisa of it.
So now that you know the map, let's meet the players. You see, it's not just a big, anonymous crowd. There are really distinct groups in this world, and they have very different amounts of power and, well, cash.
First up, you've got us, the retail investors, everyday people like you and me. Then you have the giants, institutional investors. These are the big fish, right? Mutual funds, huge banks. They're managing massive, massive amounts of money. And finally, you have the promoters. These are the original founders or the family that still controls a huge chunk of their own company.
And this chart, wow, it really paints a picture of the power balance. In a typical big company, the promoters and the big institutions own the lion's share. As retail investors, we're absolutely an important piece of the puzzle, but it's so important to remember that we're basically swimming in a tank with whales.
All right, let's dive into what is probably the single biggest trap for any new investor: that daily stock price that's always changing.
You know the one I'm talking about, the number that's going up and down every single second. It's what the news channels obsess over. It's what makes people either super excited or totally panic. It's really just the pulse of the market, and it's driven by millions of decisions based on everything from solid economic data to a simple baseless rumor.
And this, right here, is the trap. If you invest based only on that flickering number, you're not investing. You're speculating. You're treating the stock market like a horse race, just betting on which number is going to go up next. And that, my friends, is exactly how so many new investors end up losing their hard-earned money.
So, how should we be thinking about it? Well, the legendary investor Warren Buffett gives us a huge clue. He doesn't get caught up in the daily price or what he calls market sentiment. Nope. He focuses on something much deeper, much more fundamental. I want you to think of it like an iceberg. The daily price you see on your screen, that's just the tiny tip sticking out of the water. An intelligent investor, though, they look beneath the surface. They study the actual business, its profits, its products, its leadership, its potential for the future, to figure out what the whole company is actually worth. The goal then becomes super simple. Buy a piece of that amazing business when the market is selling it for a discount. And that little gap between the real worth and the price you pay, that is your margin of safety. Okay, let's keep going and see how this whole business owner mindset actually helps you out in a real-world scenario. You see, things like corporate actions can seem super confusing, but they make perfect sense when you stop just looking at the price.
So let's take a stock split. A price watcher might completely panic, seeing their precious share suddenly drop from 2,000 rupees to just 200. But a business owner? They understand that their total investment value is exactly the same. They just owned 10 shares worth 200 rupees each instead of one share worth 2,000. Companies do this simply to make the share price more affordable and accessible, which means more people can buy and sell it. It's a strategic move, not some kind of market crash.
So how do we wrap all of this up? How do you actually make that critical shift in your mind from being a market speculator, reacting to every little flicker on the screen, to becoming a successful, intelligent investor for the long run? Well, the path forward really looks like this. You start by researching the business, not the stock's ticker symbol. You analyze the company, the actual factory. Then you do your homework to figure out its true underlying value. Over time, that value grows, kind of like a tree, and that's what leads to real wealth. This is how you end up owning a piece of an incredible growth story, instead of just holding a lottery ticket and hoping for the best.
In the end, this is the choice that's going to define your entire journey. Are you going to be a spectator, just getting swayed by the crowd's emotions and all the market's daily drama? Or will you choose to be a business owner, grounded in solid research, real value, and a long-term vision? Now, you have the framework to choose wisely.